Hey, welcome to the 40 Finance channel, everybody. My name's Jeff Beers. Today we're going to have some fun with a simple portfolio challenge. I'm going to offer you two portfolios, and you have to choose one to hold for the next year. This is all hypothetical. You are not getting any free stocks from me, by the way. This is just a simple exercise. On the one hand, we've got four stocks that are arguably value traps, low momentum, stocks that have just been hammered lately. And then on the flip side, we've got ones that are more popular, I would say, and that have sustained support from their investors, even when times get tough. Spoiler alert, I'm going to take the value traps, the beaten down names, just for fun to see where we land in 12 months. Argument being you'd have more upside if those companies turned around versus the ones that are arguably already flying at peak valuation. Now, in the real world, these are all QQQ components. So in the real world, I own a small percentage of each one. So assuming that the greater share of them actually go up over the next year, I'll be happy either way. All right, in this corner, we have the value traps, or the low momentum plays that have been beaten up substantially this year. Netflix, which, yesterday's earnings call was an absolute disaster in terms of users, okay? Now, I would make the argument that from an earnings and revenue standpoint, it really wasn't as bad as what we're seeing here. But that's how Wall Street is. It's so focused on user base and a growing user base. And what we're seeing today is a lot of people agree with that metric. Next up, we have Facebook that's had a similar fate this year. Facebook, of course, is in the middle of a transition into virtual reality / metaverse. That's where their big bet is, and there's a lot of discussion between investors, like, is that the right bet? Do you think Mark Zuckerberg's gone crazy? Or do you see some value in that going forward, at least over the next 12 months? Third on the list is PayPal, and PayPal is a stock not only that I have exposure in the QQQ, but I also have big exposure. It's my top single holding. So I have felt massive pain in PayPal. I've done many videos on it, so I'm not going to bore you here. But do you think PayPal has a chance to rebound, or is this just a dinosaur fintech company, like so many people are saying right now, that eventually will just disappear and go bankrupt? And then last one on the list, Micron. Now, Micron might be a little controversial in terms of being on the value trap scale. Some people might not agree with me on that, but I'll tell you, if you look at the fundamentals and if you look at the growth trajectory that is baked in right now for Micron, they're trading essentially for one of the lowest valuations that you'll see across the chip sector. And you get a peek of it right here. Forward PE, not trailing, forward PE coming in under 8 with an EPS just shy of $10. And this does have a small dividend as well. So we'll stack that up, Micron, against our other contender in the chip space. And you'll see just how much difference there is. So I think Micron is worthy of the value trap discussion right now at this point, simply because people absolutely refuse to pay up for it. Okay, so bottom line here, with the value trap portfolio, you get these four names, one share of each. We're not worried about the value of the portfolio from a monetary standpoint. We are looking at the percentage change throughout the course of this challenge. So right now, the percentage change, since I just bought it, maybe 45 minutes ago, and I put in one share of each, is minus 0.52%. All right, flipping over here to what I'm calling the popular picks. With this portfolio, you would get Tesla, Costco, Microsoft, and Nvidia. These stocks, all in my opinion, are trading maybe slightly higher than what I would consider their fair value, but perhaps most importantly, they are the absolute opposite from a momentum and sentiment-wise than the value traps you were looking at, right? When you think about Tesla, Costco, Microsoft, Nvidia, they have loud supporters in the stock market community, right? Anything that Nvidia does, for example, it's going to be hard to poke holes in on any sort of social platform or whatever. People are going to get mad and come in and say, you're missing the point, blah, 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 blah. So I would say that these 4 stocks have very strong supporters, as well as a track record of late where they've been able to essentially maintain most of their valuation. Obviously, the stock market has been down quite a bit this year, but I will say that from a valuation standpoint, these 4 names trade at much higher multiples than the value traps. And you can see, just like I mentioned earlier, this portfolio value is technically much higher today, to over $2,000 versus $600 or something on the other one. It doesn't really matter. Doesn't really matter. We're talking about percentage change. And the way I've set this up in Seeking Alpha, we'll be able to track that at various points over the next 12 months. Quick pause. You'll notice that we're doing a lot of work here in Seeking Alpha Premium today. If you're interested in learning more about that platform, potentially supporting my channel, my affiliate link is in the description. And when you use that, you also get a nice discount on a 1-year subscription to Seeking Alpha Premium. Now let's use Seeking Alpha to dig into a few categories and compare these 2 portfolios. So I'm going to start here in order of earnings, right? So we just had a big earnings collapse for Netflix. Ironically, Tesla's up today, but we won't have that in time. But you can see how their quant score labels the earnings revisions for the 4 stocks in the value trap portfolio. So you've got an F for PayPal, which of course is not good. Facebook, D+. Micron does okay at A-, and then Netflix is down to a C-. We're less than 24 hours away from, what we saw yesterday. So this, I would anticipate, could go down over time. But this is just how Wall Street analysts have adjusted their EPS estimates. And don't forget, with Netflix, it might not go down to an F or a D because, technically, their EPS was great. Their revenue wasn't bad either. So you have to keep that in mind. This is about EPS revisions right here. Now let's take a look at the popular picks. So here we have strong EPS revisions for Tesla, Microsoft, Nvidia, and Costco. Green, A- across the board. A lot of momentum going with that. And when your EPS estimates, the consensus bar, when that starts to rise as more analysts come in, you usually see a higher projected price. If analysts are projecting the EPS times the multiple, well, if their EPS estimate goes up, and even if they keep the same multiple, then you'll see that price rise as well. All right, let's switch over to valuation. And we'll try to use all the forward metrics, right? Because we really are looking over the next year. Trailing 12 months doesn't do a whole lot for us. This isn't a race in the past. This is a challenge for the future. So PE ratio looking forward, and look at this Micron number, 7.54. So when I think about value traps or the prospect of a value trap, Micron certainly fills that bar, right? They're coming in below a 10. And even though it's the semiconductor industry, you would figure that more investors would pick up on this valuation and be interested in it. Micron's just not a sexy name. It's not a popular pick. Looking down forward PE on Netflix, getting into the 30s now. Netflix is now under 25 at a 22.39 forward PE. Then you have Facebook under an 18. So all the workings of the textbook value trap right here, and that would be the valuation multiple is low. The earnings per share look pretty solid. So you invest in it, but some people would say you catch a falling knife that way. All right, let me adjust this. PEG forward, MU 0.28. Okay, you're just not going to see that with very many stocks. Netflix down to about a 1.07. This might get adjusted as the consensus continues to build after yesterday. Facebook, 1.2, and PayPal, 1.49. And then lastly, let's look at price to cash flow. Netflix running far and away the hottest at 394. That's very high. But PayPal, Facebook, and MU, well with under 20 times free cash flow right now. All right, check it out on the popular picks. Forward PE, again, you've got Tesla now under 100, which for Tesla is really good. The question is 100 fair for an automotive maker, or primarily an automotive maker? That's the question there, but that's where it stands. Costco coming in around 45. Again, this is a retail store, so not too many people would argue that's a fairly high valuation for a retail store. Nvidia, 39 times on the forward PE. If you think back to where Micron was, right, under 10, and you'll say, well, Nvidia is doing XYZ and they're growing, and this valuation has come down considerably over time for Nvidia as we've seen the market melt down. But let's not look past the fact that this is the chip sector, and historically speaking, prior to COVID, you normally would not get valuations like this for a chip maker. And then lastly, we have Microsoft. I can just tell you off the top of my head that historically with Microsoft, you've been in that 25 to 28 range at best on forward PE. This is pre-COVID. So some people like me would say Microsoft probably has a little ways to go down yet before it reaches more of a fair value in line with the historical past. All right, how about our forward PEG ratios? Again, the closer you are to 1, the better. Costco's at 4. Tesla about 2.5. Microsoft not too far off that, 2.36. Nvidia 1.55. So if you're not familiar with this metric, I would say of these 4 names, Nvidia is probably the closest to having an argument for a good PEG valuation. Now let's look at our cash flow, price to cash flow. All right, so you've got 92 times for Tesla, 61 times for Nvidia, 26.5 for Costco, 25.5 for Microsoft. Now, on price to cash flow ratios, you probably want to eke in under the 20s somewhere. If you remember, like Netflix, for example, they're way off the charts compared to anyone over here. Netflix was like $3.95 or something like that. But any of these guys on this screen are probably running higher, at least slightly. I mean, 25, 26, it's not terrible. But again, you're going to want to get under 20 at some point before you can say XYZ stock is a good deal. All right, now let's compare growth. We're back to value traps. Revenue growth looking forward. MU, 24%. Netflix, 15%. PayPal, 17, 18%. Facebook, 21%. And if you want to talk about EPS growth going forward, MU coming in at plus 65% projected for the next 12 months. Netflix plus 33, PayPal plus 14, and then you got Facebook at plus 12.3. So the subtle hilarity here in terms of value traps is you do have companies here that are growing on both the top and bottom lines. You usually don't see that. You think about a value trap, you think about something, think of like a Coca-Cola, okay, where there's just not a ton of growth. It's single-digit growth, but the valuation is very small, right? But you may not see that valuation change much because they're never going to grow double digits. And the best companies like Coca-Cola tend to do things like share buybacks, dividend increases, etc. So they add shareholder value. But with these being all NASDAQ stocks, it's more likely that the focus is going to be on the revenue and the earnings per share growth. Now, switching over to the popular picks, you've got revenue looking ahead, plus 12 for Costco, plus 34 for Nvidia, plus 16 for Microsoft, plus 50% for Tesla. So much larger growth than we saw on the stocks on the previous page, right? So this is where your multiple comes from, and it's going to be higher, particularly with names like Nvidia and Tesla, if you're talking about 34%, 50% growth. Then if we go over to our EPS looking forward, it's a good looking story there too, plus 17% for Costco, plus 39% for Nvidia, plus 23% for Microsoft, and plus 83% for Tesla. So this is a big year for Tesla, particularly on the bottom line, the profit line. If they do grow their EPS 83% this year, then obviously they're going to grow into that valuation, right? And the question just is then, how does that change, if at all, the valuation multiple that people want to pay? All right, so we stacked up our two portfolios. We had value traps versus popular picks. Just to be devil's advocate and the type of person who's more or less a valuation-based investor, I'm going to go with the value traps to win the percentage gain race between now and April 20th of 2022. Now, I'll be the first to say this is going to be a big challenge for the value traps portfolio. Not sure if I would do this with real money, but since I own the QQQ, I really can't lose in the real world because no matter who goes up out of this lot, it's still going to be a win for me. But now it's your turn to pick. If you don't mind, leave a comment below. Let's get some votes going for this. Just simple like value versus popular picks, whatever you want to do. And we'll write it out and we'll look back at this every 3 or 4 months and see how we're doing. All right, guys, if you enjoyed this, please leave a like. I really appreciate your support. Don't forget to check out that Seeking Alpha special offer that's in the description below. Hope everyone's doing well and getting some good weather here in spring. We will see you on the next video.